Welcome back to our YouTube channel Binary Bulls. Today we're continuing our series of mastering algo trading to find our ultimate trading strategies. Ever wonder how traders predict market trends or reversals? Traders use technical indicators as a tool to make informed trading decisions. A trading indicator is a mathematical calculation based on price, volume, or open interest that helps traders analyze financial market more effectively. Let's start with moving averages. There are two types of moving averages that traders rely on the most: SMA, which stands for Simple Moving Average, and EMA, Exponential Moving Average. These are used to identify the overall trend of the market. Now let's imagine an NBA player just played 5 games and recorded their points in each game. Now let's say we want to analyze the scores using these two technical indicators. SMA 4 looks at the most recent 4 values in a rolling window, so we need at least 4 scores in order to calculate SMA 4. So for the first game, SMA is undefined. To calculate EMA, we need a starting point. There are two common approaches. First, wait for the first SMA 4 and use that as the initial EMA value, or use the first score as the initial EMA value. We'll go with the latter, so we'll assume that our EMA 1 equals 10. When we receive the second game score, 18, SMA is still undefined, but we compute EMA using a smoothing factor, alpha. We take the previous EMA 10, the new score 18, and a weight factor alpha equals 2 over n plus 1, where n is the chosen window size, in this case 4. And using the formula, we can find EMA 2, which in this case is 13.20. We repeat this process for each new scores, gradually refining EMA. Don't worry about the exact formulas and details for EMA just yet. Later in the video, we'll break it down further and even code it step by step. Once we have the 4 score, we can compute SMA using the last 4 scores, which are 10, 18, 12, and 25. The SMA is simply the average of these 4 numbers, which is 16.25. Now when you get a new score 40, the rolling window shifts. 4 most recent scores are now 18, 12, 25, and 40. So we compute the new SMA to be 23.75. On the other hand, EMA is 26.58. The key difference between SMA and EMA is how they react to new data. SMA averages all the recent values equally within the window with a weight of 0.25, as you can see, while EMA gives more weight to recent values, meaning it adapts faster to change. If we look at our EMA 5 calculation, 40 gets the most weight, 1. 25 gets the weight of 0.60, and the subsequent score gets decaying weight. Think of it as SMA is like recording players' performance over the last 4 games, treating each game equally, while EMA is like a coach evaluating a player's recent form, giving more importance to the latest performance to make real-time decisions. Now let's look at this chart. As you can see, we have 2 lines, SMA and EMA. Notice something? SMA lags behind and stays farther from the stock price. EMA sticks much closer to the stock price, adjusting faster. Why does this happen? Think of it this way. SMA is like a cruise ship, slow, steady, and smooth, but takes time to turn. EMA is a speedboat, quick, responsive, and immediately adjusting to waves. That's why traders use EMA when they want to react fast to the market changes, while SMA is used to get a broader, smoother trend. Now let's apply this concept to stock prices. The purple and yellow line you see on this chart are moving averages, which helps traders identify trends. This chart shows that the trend is bullish, as prices are rising, and the moving average lines confirms the uptrend, indicating that prices are likely to continue higher. Whereas in this chart, prices are declining, and the moving average line confirms the downtrend, meaning prices are likely to continue lower. Please do keep in mind that nothing is certain in the stock market. Moving averages are just tools to help us predict market trends. Markets are unpredictable, market does what it wants. That's why it's crucial not to get married to a single strategy or bias. Before we dive into coding, let's break down the math behind moving averages in a way that actually makes sense. Let's take a simple example. The real closing prices of E-mini S&P 500 futures in a 3-minute interval candle on a specific date. Each time period records a new price, and our goal is to compute EMA for these prices. The key to EMA is alpha, the smoothing factor that determines how much weight we give to the latest prices. The two common formulas for alpha are standard alpha, which is 2 over n plus 1, Wilder's smoothing factor alpha, which is 1 over n, where n is the selected time period. For example, if we calculate EMA for 14, alpha equals 2 over 14 plus 1, which is 2 over 15, and it's roughly equal to 0.1. For the calculation of EMAs, we'll be using alpha as 0.1. The formula for moving average is current EMA equals current price weighted by alpha plus previous EMA weighted by 1 minus alpha. The EMA calculation follows a recursive formula, meaning each new EMA builds up on the previous one. Let's apply this to a series of our closing prices. For P1 at T1, we don't have a previous EMA, so we set the current price as the initial EMA. This approach stabilizes faster compared to initializing it at 0. Another option is to wait for the 14-period simple moving average and use that as an initial EMA. For P2 at T2, the initial EMA becomes the previous EMA, and we apply the formula current EMA equals current price times 0.1, which is our alpha, plus previous EMA times 0.9, which is 1 minus 0.1. Similarly, at T3, the EMA at T2 becomes the previous EMA, and the new EMA is calculated using the same formula. So EMA at time 3 equals 0.1 times price at 3 plus 0.9 times EMA at 2. Expanding this further, we get EMA at A3 equals 0.1 P3 plus 0.9 P2 plus 0.9 squared P1. Following the same approach, by the time we reach T6, the weighting pattern becomes evident. The most recent price, P6, has the highest weight of 1. The previous price, P5, is weighted by 0.9. P4 is weighted by 0.9 squared, and so on. The older the price, the more its weight decays. In this case, by a factor of 1 minus alpha equals 0.9. The visualization here illustrates how EMA assigns exponentially decreasing weights to the past prices. After approximately 14 periods, the weight becomes more negligible, making the EMA effectively dependent on the most recent 14 prices, but in a smoother manner. Now that we understand how SMA and EMA is calculated, it's time to bring them to life by coding them into our charts. Let's create a Python file called movingaverage.py. First, let's import few packages. We'll be using pandas and lightweight chart like we did in the previous video. In addition to that, we'll be using Python library called talib, which stands for Technical Analysis Library. It comes with all the essential technical indicators already built in, so we don't have to code them from scratch. While we could code our indicators, for simplicity, we'll stick with talib. Let's install our talib packages. To do that, simply run pip install talib. This should install talib inside your virtual environment folder. There is a known installation error with pip installs in MacBook M3 chips. If you are also using M3 as well, to fix this, follow these steps. Brew install talib, set the required environment variables, and finally do pip install. And in this case, you need to give the exact version also, which is 0.6.1. In the previous video, we stored our chart data in a CSV file. We'll be using the same data. Let's do name equals main. This line makes sure that our Python runs as a standalone script. Now let's load our OHLC stock data from the CSV file that I mentioned earlier. Now let's rename datetime to date for our lightweight chart library. Similarly, convert date string to datetime object. For the time period, we'll be using 50 to calculate our 50-period SMA and EMA. Now let's define functions to calculate SMA and EMA. First, let's do SMA. We'll use talib's SMA method, and we need to pass the closing price and the time period, and return data in a pandas data frame required by the charting library. Now let's do the same thing for EMA. Now let's call those function in our main script. We'll be showing this in a chart. So let's initialize chart. We'll do legend visible equals true. Now let's define two lines to plot SMA and EMA in the chart. We'll use color as blue for SMA. Now let's do the same thing for EMA. We'll use color as red for EMA. To simulate prices in our chart, we'll use the initial price and generate the following prices. So df1 equals df ilog. Now set the initial bar in a chart. Also set the initial line for SMA and EMA in the chart. Now we want to iterate through the time and get our close prices, EMA and SMA for the time period. Now let's update price bar. We'll skip 50 periods since our 50 period moving average requires at least 50 closing prices. Then after 50 prices, we'll update the SMA and EMA lines. We'll add a slip to delay our bar animation. And let's do block equals true to pause the animation once it's done. Now let's run our chart animations. Hit enter. If we observe the chart, we can see that we're skipping the first 50 bars since our moving average needs at least 50 bars to compute. Here in the chart, EMA is red line and SMA is blue line. Notice how SMA lags behind price movements while EMA reacts more quickly. This responsiveness makes EMA useful for traders looking to catch trends earlier. Now that we have explored SMA and EMA, you should have a solid understanding of how traders use them to analyze market trends. In the next video, we'll cover another powerful and commonly used technical indicator, RSI, which stands for Relative Strength Index. RSI helps trader measure market momentum and identify potential overbought or oversold conditions. If you found this video helpful, drop a like, subscribe, and hit the notification bell so you don't miss the next episode. See you in the next video as we continue mastering technical indicators.